a much looser market in 2022. So let's not overdo things. They also argue that the energy crisis is not an oil crisis, it's actually a gas and a coal crisis which is spilled into the oil market, and that actually policymakers are looking in the wrong place.
Will, to John's very good point about the incredible hypocrisy of all of these countries that are trying to pledge greener futures, pleading for more oil, pleading for more coal, is there more investment at this point, or do you foresee a greater pace of investment in greener technologies, given how much that was highlighted, the need for that kind of technology in the past few weeks?
I mean, we are going to get those green investments. The question is, are they going to be fast enough and quick enough to really make a difference? And the answer is probably no. But I think people who are expecting a significant ramp up in oil and gas investment are also likely to be disappointed. Among the world's very big oil companies, both the Shells and BPs on this side of the Atlantic and the Chevrons and the Exxons, they are increasing investment a little bit, but they're not. They're under big pressure from their shareholders not to go too fast. And the emphasis really among, and we've just been through earnings season, the emphasis among investors in big oil is just concentrate on your cash flows, give us back the money, let's not invest too much. Let's really, and that's why people are worried that you're going to get a mismatch between oil demand and oil investment. And there hasn't been much signal that that's likely to change.
Hey, well, you alluded to something just a moment ago. I want to build on it and not lose that moment. You talked about maybe we're looking at the wrong price. Are you talking about natural gas, that maybe that's driving what's happening in crude and energy across the board a little bit more? And when it comes to natural gas, what on earth can these leaders do about it?
I think there's a feeling that this winter, a lot of the tightness in our market is being driven by this wider energy crunch, because if you're short of gas, if you're short of coal, especially in emerging markets like China, importantly, what you do is you go and buy a diesel generator and make your own electricity out of diesel. And I think there's a real fear that that's what's making the market tight this winter, and that's why OPEC argues that's a short-term thing, that's something that we don't have much control over, so let's not flood the market now and create a bigger problem next year. What can anyone do about the gas price? It's hard. I think the main thing we can do about the gas price is hope that it stays warm. It does seem that some of the heat has come out of that market. It may be that Russia has filled its own reserves and is able to supply a bit more gas over the coming months. But again, OPEC would say it has very little control over that situation.
So, well, there was conversation around OPEC over the weekend at the G20, but there was also conversation around Iran and more potential nuclear deal conversations happening later on this month. Does that have any real bearing on the oil market at this point?
Well, it's an interesting question, Kayleigh, because one of the things happening in the oil market this year is, if we think back to the spring and the period after Biden's inauguration, there was a lot of hope that we'd get a fairly quick deal to bring everyone back into that nuclear agreement, which would allow Iran to export more oil, and that hasn't happened. And that is one thing that's really changed the supply and demand outlook this year, that we haven't had that return of Iranian oil, and that's made things a lot tighter than people may have expected. If it comes back next year, that's again going to be part of the conversation, and another reason that OPEC would be able to argue that they shouldn't do too much at this stage, because they've got to protect against that extra oil. But there's a long way to go before we can start thinking about seeing that Iranian oil back in the market.
So when OPEC meets later on this week, do you expect we'll hear anything out of them that's a change in tone of the last couple of meetings?
Look, they are coming under really sustained diplomatic pressure here. We saw that through the weekend. We've seen that in Biden's on-the-record comments last night, and we've seen it, as we reported on Friday, through a really big private diplomatic effort, not just from the US, but also from leading Asian importers, China, India, South Korea, Japan. They're all worried about prices at this level, stoking inflation and dampening the prospects for economic growth. And, you know, OPEC will be worried about defying its biggest customers, especially in Asia. But so far, everything we've seen suggests that they're going to hold the line. They think their policy is the right, and they don't want to give in to this pressure. I think over the next few days, we need to look at the price. If it stays here, OPEC may be confident enough to say no at this stage. But if we really see a rally build towards 90, that pressure is growing more intense. And as we all know, OPEC decisions can look nailed on 24 hours before the meeting, but when you get there, things change very fast.
Hey, well, the president trying to put a bit of pressure on OPEC over in Rome, Italy. The president now moving over to Edinburgh, Scotland. For anyone following the president today or playing follow the president like we are, this is what the agenda looks like for the next couple of hours. The president touching down in Edinburgh in the next 10 minutes or so. It was meant to be about 10 minutes ago. He'll go from there to Glasgow, Scotland. He'll meet with the Prime Minister, Boris Johnson, and the Secretary General of the UN, Antonio Guterres. From there, we will hear from the president at around about 9:05, 9:10, something like that, Lisa, when we open up with leaders' statements at about 9 Eastern time. The president, I understand, is third in line, so we'll get his thoughts pretty early on.
Yeah, I'm curious, though, to see how much he pushes back on some of the oil price rise, considering the fact that this is sort of one of the solutions to emissions. If people are having to spend more, they will buy less. And Will, this really goes to the heart of the public versus private debate. A lot of people saying that the private market has really taken the lead, and they have looked to earnings to hear what companies are doing to reduce emissions. How much are you hearing the opposite from big oil? The idea that maybe they're reinvesting in oil production, given some of all the interest, and feeling emboldened because of the political stance recently?
I think big oil will take a little bit of comfort from what's going on in terms of climate politics. You know, that the G20 statement was not as strong as people would have liked, that clearly the US is as concerned about rising gasoline prices in the short term as they are about emissions in the medium to long term. I think that gives big oil comfort. But as I said a moment ago, among people who own big oil, even Exxon, Chevron, they're very focused on keeping spending under control and maximizing returns for investors through buybacks and dividends. They are less focused on investing for the long term, for increasing production, even if they don't think those companies should be investing in new energy. They just want the cash.
So does that mean you don't think we're going to see more real capex out of some of the oil majors? Well, it will all be, buybacks and dividends?
It's looking like that. There'll be some increase, but a lot of that increase will be driven by higher costs. I mean, steel is extremely expensive, which is one of the main components in oil and gas projects. So there's got to be some natural uplift just to increase in inflation. Will we see a step change? Will we see a change in paradigm about how management teams and boards approach investment in oil and gas? Maybe, but I don't think we're there yet. Oil's going to have to go a lot higher before we really change that, I think.
Hey, Will, can you tell Jamie that we missed him today?
I will.
Mind? Thank you, buddy. It's good to see you. Will Kennedy there, out of our offices in London, on the situation with crude. One thing we have not talked about yet, Lisa, late on Friday, Goldman Sachs came out with a note on the first hike at the Federal Reserve. Let's talk about that right now. The first hike for them, July next year. That's a change. The market's already there.
Yeah.
Let's be clear about this. As economists that are lagging here, the market is there and economists are starting to move.
There was a data point on Friday that came out that I thought was sort of shocking, that I think changed the conversation pretty significantly, and that was the employment cost index. And it came out rising at the fastest pace on record. And I do wonder how much this is going to trigger the Fed in a new way, and I wonder how much this is behind some of the reassessments that we're hearing from not only the market, but economists themselves.
Ian Shepherdson called that, what did he call that, Kaylee? Alarmingly big.
Yeah.
The ECI, alarmingly big.
Yes. Yeah, I mean, it was almost double what the expectation was, and it really raises the question of wage pressure. We've been so focused on kind of supply side issues, higher commodity prices, higher food prices, that kind of inflation. When does that translate to when companies have to raise wages for workers in order to get them into the door? Something more persistent and more structural that you can't really say is transitory, and is that what is going to create the pressure on the central banks? Goldman Sachs saying by the time the taper ends, we're still going to be looking at 4% core inflation.
They think we get 2 hikes next year, then another 2 after that. Lisa, this was the reaction from Bank of America just to what we're seeing so far going into the Fed decision, and it puts this all together quite nicely. The Fed is unlikely to push back on market pricing until they gather more data to determine the tightness in the economy and risk to inflation. Watch the supply side into year end. Watch the supply side, and I think we're all doing that.
Yeah, and I will say, because we are going to get the Treasury announcement as well on Wednesday for refinancing, and they're going to say the pace of their debt sales are going to go down as well.
What a week we've got coming up for you. Isn't it fantastic, Lisa?
I'm so excited. I have so much to talk about.
Did Tom take the day off because he wants the Spurs job or because he needed a rest ahead of a big week?
I'm going to take...
What is it?
I'm not going to comment,
Is he
but
doing
I'm
a
going to just
live
hint
show
that
for the RBA decision overnight? Is Tom coming in?
He's going to try.
For the Australian Central Bank decision? He doesn't sleep. Equity futures up 0.4% on the S&P. Good morning to you all time highs in America to kick off a really interesting week. This is Bloomberg.
With the First Word News, I'm Laura Wright. Jess Staley is out as CEO of Barclays. He's stepping down in the midst of a British regulatory probe into how he characterized his ties to the late financier and sex offender Jeffrey Epstein. The bank says it was made aware of the preliminary findings on Friday evening and says Staley plans to contest the findings. He'll be replaced by the head of Barclays Markets Division, C.S. Venkatakrishnan. More than 5 million people around the world have died from the coronavirus less than 2 years after it was first documented. Still, the arrival of vaccines has slashed fatality rates. The latest 1 million deaths came slower than the previous 2. The death rate has returned to what was seen during the first year of the pandemic when the virus was still taking hold. France and the UK are headed for a full confrontation in the next 2 days over fishing rights. On Tuesday, the French government is set to introduce additional controls on goods moving across its border with the UK, plus British fishing boats will be blocked from unloading their catch in France. In Japan, Prime Minister Fumio Kishida avoided the worst-case scenarios with his month-old government. Kishida's Liberal Democratic Party won 261 seats in Sunday's election to preserve its outright majority in the lower house of Parliament. Still, the Prime Minister was left with a slimmer margin to push through his policies. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Engine number one was able to do on the Exxon fight. It opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that as either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in Engine Number One on the idea that we take the data, not ratings and rankings of the ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year. Yeah. And so our approach is, is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
Bloomberg Television and Radio.
We are on the verge of a disaster.
Join us live from Glasgow for coverage of the COP26 Climate Change Conference.
People are beginning to build some momentum, I think. The question is, will it be enough?
We'll speak with global leaders, keep you up to date on progress and setbacks, and analyze what it all means to you.
We're going to need to see some real action.
COP26, the UN Climate Change Conference. Special coverage on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Certain countries have been doing a fantastic job. Most of the time, it's because they've had the resources to be able to get their orders in for vaccines, to get those vaccines delivered early. But the vast majority of the world is really stuck at the starting line.
Always great to hear from Dr. Andy Pekos there of Johns Hopkins Bloomberg School of Public Health. From New York City this morning, good morning. Alongside Lisa Brabbitts, I'm Jonathan Ferro, together with Katie Lyons. Tom Keane back with us tomorrow, I hear. Up 20 on the S&P, advancing 0.4%. Yields higher by a couple of basis points on 10s, up to 157.50. Crude one to look for, just south of 84 at 83.95, positive 4 or 0.5%. Love this from the Washington Post, Lisa, in the last couple of minutes. In an interview aboard a government airplane between Rome and Dublin, somewhere over the Alps, they say. Here's the lead paragraph. Secretary Yellen on Sunday said Democrats should be willing to approve a fix to the nation's debt ceiling without GOP support if necessary. Just a little bit of a subtle shift there, Lisa, on a key issue.
And I do wonder how much this indicates a lack of agreement, frankly, a lack of any progress between Republicans and Democrats, a lack of feeling that there's going to be some consensus to avoid defaulting, John. I mean, otherwise, why make this subtle shift that leaves the door open to actually fixing the issue without the GOP on board?
Are we getting some votes this week, Kaylee, down in D.C.?
Good question, John. In theory, by tomorrow, lawmakers would like to see votes on both the bipartisan infrastructure package and the social spending package. But even putting that aside, when we think about this debt ceiling issue, if December 3rd is the deadline, I just took a look at the calendar. We have a lot of recess for both the House and the Senate in the month of November. There's actually only 13 working days between now and that deadline because lawmakers will be taking a little break next week and as well for Thanksgiving. So that's not a lot of time. If you are indeed going to push it through reconciliation, your window is getting a lot narrower.
I don't want to start the week with too much snark here, Kaylee, but do you think they could just cancel the vacation, the break?
One would think.
Focus on the work. Lisa, can we get that done?
Okay, John, honestly, when you start any sentence with, I don't want to start the week with too much snark. Here's the snark, and here's some more snark.
I'm just saying I'm going to deliver some snark and then pull back on the snark for the rest of the program.
Are you really?
That's all.
I'm going to keep you to that.
I'm going to front load the snark for the 6th.
So?
Then when our radio audience joins us worldwide at about 7 a.m. Eastern time, I'm going to pull back.
Let's see about that.
They'll get a different experience in the next hour. Just variety. Keep them guessing, Lisa.
I can imagine.
That's what this show
a new
is
Jonathan
about.
Farrow, completely open,
after
unsnarked.
a couple of days off.
Yeah, no way.
Snark. Dr. Joshua Sharfstein joins us now, Vice Dean of the Johns Hopkins Bloomberg School of Public Health. Doctor, great to catch up with you, sir. Parents across this country want to know, when do we finally get some hard guidance on whether they should vaccinate their kids?
Well, I think they've got a good sign from the FDA last week, which authorized the Pfizer vaccine for kids 5 to 11. And this week, the CDC advisors will meet and will make a recommendation. And I think pretty soon after, the vaccine is going to be made available because the country has been moving that vaccine around to get ready for an announcement.
Dr. Sharfstein, very much in focus right now is how we deal with vaccination, how we deal with mandates, given the fact that we have the vaccine. It does seem to be the cure, but there is still concern out there. And I'm wondering about New York City workers. The ban is in now. You have to get a vaccine or you cannot show up to work. Testing is not an option. A lot of people not coming in. Is this the right way to do it?
Well, it's complicated, and my view on that really depends on the particular type of occupation. There are a number of jobs where people can really make other people sick. I mean, healthcare workers can make their patients sick. That goes for, I think, the police, firefighters who are out there in people's homes. If they are passing COVID on, I think that's terrible, and I think it's totally appropriate for there to be a requirement. Now, when you make a requirement like this, first of all, you've got a big chunk of people who are already vaccinated. Then you have a lot of people who just go, okay, I'll get vaccinated. I've been sort of putting it off, but I know I need to get it. And I was out vaccinating this weekend, and a bunch of those people came in. They're not even upset. They're just, I've got to do it. But then you've got people who are really hardcore refusers. And that's really difficult for them, and it's difficult if there are a lot of them. And we're going to see in these different markets, in these different occupations, whether that's very disruptive or not. Even some of them will get vaccinated if sort of pushed, but it's really an unpleasant experience for everyone when that happens.
Doctor, always good to get your thoughts. Come back soon and we can talk for a little bit longer. Dr. Joshua Sharfstein there, joining us on the vaccine in this country. The nature of covering a conference is you're sitting there and someone drops by for an interview, maybe unexpected, the timing can shift. And we've got a fantastic guest coming up now with Bloomberg's Francine Lacqua over in Glasgow, Scotland. Hey, Francine.
Hi, John. Yeah, we're delighted to be joined by Mark Carney here, of course, looking at finance, looking at COP26 in Glasgow. He's also former Bank of England governor. Mark, as always, thank you so much for making us smart on what finance can do, because COP26 starts today. The G20 was a little bit of a doldrum because we didn't get some of the pledges that a lot of people were hoping for. What does it mean for your expectations for COP26?
Well, I think a couple of things. I'm going to quote the Secretary General's: hopes unfulfilled but not yet buried. The 1.5 degrees anchor in the G20 communique is significant. Some progress, but we've got a lot of work to do. And the big question for this week, at least for this Wednesday, is what can finance, and more specifically the private financial sector, what can it do to help solve this problem? So it's going to really have to step up, and there's been a lot of institutions, a lot of people around the world who've been working in order to do that.
Yeah, we don't even have a price on carbon yet. When will we get that?
Well, we don't have a price on carbon, but what I think our message on Wednesday to world leaders, to policymakers, to business people around the world is finance is going to be there, and finance is going to be there in two respects. One, we've retooled the financial system. We've changed the plumbing, if you will, the financial system, a bunch of very worthy reforms that actually, to be honest, only the audience at Bloomberg would fully understand and appreciate, and we can go through them for the next hour. But, you know, think mandatory disclosure, think stress testing, all that. So part of it is retooling, but then it's also about financial institutions stepping up and saying that they are going to finance this transition, this enormous $100 trillion transition that needs to happen over the next 3 decades. They're going to finance it, and they're going to mark their own homework. They're going to show up year in, year out, say what their emissions are of their clients, have specific strategies for reducing carbon, fair share of 50% down by 2030. That's what the Glasgow Financial Alliance is all about.
Why not stop actually putting money into fossil fuel, full stop, instead of talking about the transition?
Well, we're living through problems with the transition right now in terms of we have both far too many fossil fuels in the world. We're going to have enormous stranded assets, half of gas, 3/4 of coal, etc. Maybe up as much as half of oil reserves, proven reserves, need to stay in the ground if we're going to get to where we are. But we also have local short-term shortages of some of those exact materials. We're here in the UK, there's a shortage of the storage of gas. So there needs to be only some limited financing for a transition, but only for a transition, which is why you need things like GFANs that are relentlessly, ruthlessly, absolutely focused on that transition to net zero, and not just any transition, a 1.5 degree transition, which is what G20 leaders signed off on yesterday.
The G20 leaders didn't stop, for example, coal from being used domestically.
Yeah.
And so we're doing progress, but we're going at it slowly.
Well, we're doing progress. We need to accelerate it. We need to recognize there's differences, and as there obviously are, between advanced economies, developing economies. Some of those, there's a different timeline for fully ending coal. We want to stop coal, not just new coal, but stop use of coal by 2030 in the advanced economies. That's what Powering Past Coal, which is a big element of COP26, is about. But also by the end of the next decade in the emerging developing world. And if I may, again, to bring it back to finance, to give them the confidence to do that, they need to see literally a wall of money that's available for their transition. So when they're building up alternative energy, that the money is going to be there.
Who could do better in finance? Is it the asset managers or the big banks?
Well, what we're going to reveal on Wednesday is who's doing the best. And so from asset managers, sneak peek, well, look, the problem is it's a $100 trillion problem, and so the question is who's stepping up for the solution. The members of GFANs, so those are in Net Zero Banking Alliance, Net Zero Asset Managers Alliance, the asset owners, the big pension funds, stepping up with these commitments, and then we need to channel them to where they're needed the most.
How much stress is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green enough?
Well, look, there is some stress, and it's great that there is that. It's not great that it happens, but it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's a simple, these are hard numbers. Your emissions are either A or B, they're going up or down. And if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked of other things. Now that's moving to become mandatory, compulsory after that period of time. What we're talking about in terms of net zero disclosure, moving that to compulsory, absolutely. I think we have a couple of year window where best practices develop by the private sector on what exact information is used, stakeholders make those judgments, and then, yes, I think those jurisdictions, major jurisdictions, should make this compulsory.
I mean, economically, we're at the crossroads because of the energy crisis, because of inflationary pressures. Does it worry you that actually it puts the transition backwards a little bit?
Well, I mean, if I were a policymaker, I'm not one at the moment, but if I were always a policymaker at heart, and I care about the economy. Look, I think one of the opportunities to turn the easy bit of the recovery has been reopening our economies. Yes, there have been some frictions, but we've gotten that boost of growth with reopening. Now we need to sustain an expansion. We're only going to do that with investment, business investment. Business balance sheets are in pretty good shape. If you have directions such as moving towards a net zero economy, we have huge investment. That 100 trillion figure I mentioned has huge positive GDP multipliers as it comes forward. So that's the opportunity to unleash, to turn recovery into an expansion.
But so if we get a temper tantrum, I don't know whether we do a taper tantrum, taper tantrum, then what does that mean for ESG product appetite?
Well, again, what I'm looking for, so when you look for where to be in financial markets, given a situation which, yes, there is an adjustment going on interest rates. I'd rather have this adjustment going on in interest rates rather than slipping back into a liquidity trap, which is where we were. We were on the cusp of a liquidity trap for many years after the financial crisis. So now as global interest rates are moving up, ideally what's happening is real interest rates are moving up because we're getting the kind of investment and kind of returns that we need. That's sustained recovery. You want me to stop? You're having a tantrum.
We have to stop. I'm having a time tantrum, but we'll get you back on. Mark Carney, thank you for joining us. This is Bloomberg.
We're seeing is just a reflection of continued uncertainty in the economy.
The actual earnings and the guidance continues to reinforce this upward trajectory.
I think we're going to stay in a positive environment for equities.
This isn't a bond market that's telling us that disaster is ahead.
I don't think we're at the peak pressure from markets yet. I think there's probably more to come.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What a week we've got coming up for you. From New York City, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow, together this morning with Katie Lyons. Your equity market has a lift, a bid. Lisa up another 0.5%. This record-breaking rally continues.
I do find it amazing that the market is pricing in 2 rate hikes next year. This is a huge repricing, and we see it increasing every day and globally. It is not shaking the equity market. Why? Why does the equity market shrug off the potential for near-term rate hikes at a time when growth is still in question on the longer-term basis?
Things can only get better. Lisa seems to be the view of things, apparently. Katie Lyons, it's unreal. Amazon, Apple, nothing stops this equity market, seemingly at the moment, from churning out another all-time high.
Yeah, absolutely shrugging off those disappointing results from 2 giants on Friday. I would point, though, to a note out of Mike Wilson over at Morgan Stanley this morning. He says this could maybe last until Thanksgiving, but not much longer than that. He points to tapering earnings growth starting to slow into next year. He says the fundamental picture is worsening, so therefore this bullish trend can't last much longer, John.
We've got all the ingredients, the recipe for a sell-off, Lisa, except we haven't had the sell-off part of it. On the rate story, you just wondered this week, do we finally get some pushback from this chairman on this rates pricing, which has really built up, not just in America, but worldwide?
By the way, you said everything can only get better. What happens to the no snark hour? I just want to say, I'm just saying, it's a couple minutes.
Genuine thought of mine that things can just get better.
Oh yeah, I'm sure that's what you meant.
What made you think that was snarky?
No, of course not.
Maybe I've just taken a few days off. I'm a changed man, and I'm optimistic about the future.
Okay, well, I'll hold you to that. I will say, though, on the rate hiking idea here, the idea that the ECB tried to push back, it didn't work. What does that mean? What happens if Fed officials try to push back and the market doesn't buy it? Is that worse for markets because it means the Fed has lost control over the message?
Are we calling that a pushback from the ECB last week?
I mean, they kind
Thursday?
of tried.
It was a bit lightweight, wasn't it?
It was, but at least they said it doesn't cohere with what we're seeing. There was nothing. If anything, the market actually took that as actually having more conviction with sooner rate hikes.
Imagine you're playing in the World Series, right? Let's just imagine the last game of the World Series and someone just says, here you go, softball. Just putting it out there just to hit a home run. Katie, this is how it went. Do you think markets are getting ahead of themselves? And President Lagarde just dropped the bat and walked away.
Yeah.
It's not for me to say.
It's not for me to say. I would argue that she really didn't try that hard to push back at all, or at least she could have tried a lot harder. The question is, will we see more firm pushback from Chairman Jerome Powell this week, John?
Kelly Lyons has a message for Frankfurt, Germany. Try harder. Equities up 21 on the S&P, up 0.5%. That wasn't me. Yields higher by a couple of basis points on 10s to 157.68. In the FX market, euro just a bit firmer. Euro dollar 115.72. And crude, that's where the focus is at the moment. Lisa, in the energy market, in oil, 83.97.
And this happens with OPEC Plus not necessarily caving to President Biden and, frankly, other political figures around the world saying, please pump more oil. And they're saying, nope, not going to do it. At least there isn't necessarily the need that we see, which is the reason why we see oil prices climbing a bit, which is interesting in light of COP26, which is occurring in Glasgow. Leaders gathered yesterday. They are gathering and more formally presenting today. A lot of lofty goals. What are they actually going to get done with the G20 meetings? It seems like not very much, which is somewhat concerning to a lot of the people who we have been speaking to. There needs to be more concrete action. We just heard from Mark Carney. Going forward, the idea moving now is what can concretely be done from both political officials as well as the private sector. And then, of course, at 9 a.m. or around there, we're going to hear President Biden give his initiating statements as he takes the helm at a time when his approval rating is pretty low. It actually has fallen to 42% in the latest NBC News poll. The idea here that this is the lowest approval rating for this point in a presidency, going back in history with the exception of former President Donald Trump. And then at 10 a.m., we get a slew of economic data. October market U.S. manufacturing PMI, ISM manufacturing PMI, construction data from September. How much are prices going up? How much is this actually supporting the manufacturing industry in the short term as they are able to pass along versus hampering growth? And John, to your point about people able to shrug absolutely everything off, there are signs that supply chain issues are getting worse. People took comfort in the fact that freight rates went down just slightly, and that gave people a lot of confidence, but they have gone back up. At what point do we see an end to some of these supply chain disruptions, and at what point do markets care?
Can we keep looking through it? Can we keep looking through it? That seems to be the big question of the moment. The President of the United States has just touched down in Edinburgh, Scotland. He's going to head over to Glasgow shortly. He touched down just several minutes ago. After that, of course, we'll hear from the President of the United States. We get these leaders' statements, Lisa, that started about 9 Eastern time. I understand the President of the United States is third in line for that address. So we'll hear from him, what, let's guess, 9:10, 9:15, something like that. We'll take those comments, Lisa, live and in full on Bloomberg TV and radio.
How much is he going to talk to the international audience versus his home audience? And which audience is he going to speak to at a time when he's splintered at home? That's my question.
I think what's interesting right now, as he engages abroad, Katie, we could get something done domestically this week in the United States.
Could is the operative word there, John. In theory, by Tuesday, they would like to see votes in the House and Senate on both the bipartisan package, which, of course, has already passed the Senate, and that social spending. But even Bernie Sanders over the weekend was saying we really should iron things out in the Senate first, make sure Manchin and Sinema are actually going to be on board before we send that package over to the House. So, yes, in theory, this week could be live in terms of actually getting something done, but there's always a question mark down on Capitol Hill.
So the president landing in Edinburgh, he'll head to Glasgow for the opening session of COP26 in Glasgow, Scotland. That takes place in about 54 minutes' time. As I say, you'll hear from the leaders again at about 9 Eastern time. The president third in line to deliver his statement. I have to say, sitting in this seat has always been an honor for me to cover this industry. Working in this industry is really, really difficult, and we're always very happy when someone we like gets a new seat. Troy Gajewski has got a new seat, the Chief Market Strategist at FS Investments. Troy, congratulations. Before we start the conversation, just talk to me about the new seat you've got. What's going to change for you?
Yeah, so I'm incredibly excited to join FS Investments as their chief market strategist. So, you know, it's a firm that I've known since 2014 when I had the pleasure of meeting the founder, Michael Foreman. You know, one of the things that attracted me to them was not only investment excellence, but the fact that they took that investment excellence and found pretty unique ways to package sophisticated strategies so that retail investors could actually access them. As you remember, in our industry, a lot of the early stage, more sophisticated alternatives were really exclusively for sovereign wealth funds or pensions. So getting to work with a firm whose DNA is tied to finding ways for retail investors to participate, very, very exciting. And, you know, right now, as you guys know, one of the biggest challenges for all investors is what to do with their fixed income allocation, and they have a variety of really exciting solutions there.
I will never underestimate anyone's ability in this industry, Troy, to deliver a marketing pitch just like that on a dime, just ready to go.
Doing what I can, John, doing what I can.
Hey, Troy, let's start this interview properly. The Federal Reserve, big build up in the front end of the curve. How much pushback this week?
Well, I don't think there'll be a lot of pushback from the Fed. I mean, I think they're going to talk more broadly about the fact that they're going to be patient. But, you know, at the end of the day, and Lisa was bringing this up before, markets are getting more and more comfortable with the probability of them hiking at least twice next year. And that's certainly good news from a standpoint of market stability. But other than that, I mean, remember, what will stop this rally, and I disagree with Mike Wilson with all due respect, is probably going to go into January at least, is when liquidity finally starts to wane meaningfully. We've seen a meaningful drop over the past 5 months, but M2 is still growing faster than nominal GDP. And given the seasonality right now, we do expect the green light to stay go. But as we get into next year, that light's starting to flash yellow, right? Because, you know, as the Fed tapers, you're going to have slower M2 growth. As markets start to focus more and more on the potential hikes, you'll see that flat line. And so that's when you start to get into a period where it could have multiple corrections.
There's another way of saying this, another way of tracking this, and that perhaps is the real
Yesterday,
yield. And I was
together with
looking at Lori Calvasino note of RBC Capital, and she was saying really what's behind the rally is the fact that yields have remained so negative on a real basis in the 10-year space, in the 5-year space, et cetera, meaning basically inflation expectations are rising much faster than nominal yields. At what point do you expect that to reverse, if at all? In other words, is this unsustainable where we are right now?
Well, yeah, so go back to the last cycle, right? Remember, we only got to real yields in the front end towards the end of the Powell hiking regime, and markets didn't take that too well, right? So as we look into next year, remember, there's a couple accidents that could happen. One is the Fed is forced to tighten faster. Even if they should, they probably won't. The other is that the bond market starts to actually price in meaningfully higher inflation like we're living in right now. And as you get that big back end of the curve move, you start to price in closer to flat. Did you hear me, John? I just said closer to flat real yields. and that leads to some type of dislocation. But the bottom line is at multiples at these levels, you know, when you think about where yields are rising, you think about liquidity is going to slow down. You know, now is really one of those times where you want to start to diversify into alternatives.
Troy, I often say that it's a strategist's job to read bedtime stories to people nervous about the market and to help them sleep at night and to stay invested. Is that job easier or harder right now?
Yeah, you know, I think right now it's easier, right? Because it's a risk-on environment for markets, right? And there's a lot more FOMO now than there was, say, you know, during the Eurozone crisis or 15, 16. So I think the challenge for strategists now is to get people to focus on other assets where they can potentially not have as much upside as equities in the short term, but have a much less downside, you know, particularly in things like senior secured commercial real estate, floating rate debt, other more hybrid strategies and corporate fixed income, things that can hit that mid to high single digit return with far less downside when the inevitable occurs next year in multiple corrections.
I'm always listening, Troy. You know that. Always listening.
That's good. That's good. I'm always listening to you too, John.
Good to hear from you, buddy. Troy Gaeski of FS Investments on this market. Lisa, nothing seems to stick.
No, and did you hear me? I'm not actually pessimistic over the next few months.
I mean, just a little bit.
Well, I mean, I'm pessimistic, sure. But I see Lori Calvasino's argument, the idea of negative real yields being so negative. Where else are you going to go? And this is actually one of the main arguments for the risk-on move.
All-time highs, and we add some weight to the S&P 500.
Did you hear me, John?
Troy Gaeski, I heard you.
Did you hear me?
Are we going to cut that and replay that?
Please.
Did you hear me, John?
Press a button.
Kaylee Lyons in for Tom Keene today. I'm Jonathan Ferro. Your equity market up 22, advancing 0.5%. Keep saying it. I'm going to be on repeat all week. What a week coming up. From New York, this is Bloomberg.
With the First Word News, I'm Laura Wright. There's a change at the top of Barclays. CEO Jes Staley is stepping down in the midst of an investigation into how he characterized his ties to the late financier and sex offender Jeffrey Epstein. On Friday, Staley and the British bank received UK regulators' preliminary conclusions. Barclays says Staley intends to contest the findings. Barclays will replace Staley with the head of its markets division, C.S. Venkatakrishnan. British Prime Minister Boris Johnson is expected to deliver a stark warning today at the start of the United Nations Climate Change Summit in Glasgow. According to his pre-prepared remarks, Johnson will say that, quote, it's 1 minute to midnight and we need to act now. He'll call on leaders to improve their promises after the G20 summit produced a lukewarm agreement. The US and the European Union have reached a tariff-busting trade agreement to fix the steel and aluminium markets. They'll try to leverage it into a broader global arrangement that would penalize countries that don't meet low-carbon targets when producing the metals. The accord will remove tariffs on as much as $10 billion of goods. Coca-Cola reportedly is buying full control of the sports drink Body Armor for $5.6 billion. According to Dow Jones, that values the brand at around $8 billion. The estate of the late pro basketball star Kobe Bryant will receive more than $400 million for its stake in the company. Bryant had invested roughly $10 million. An offer from the world's richest person, Elon Musk. He tells the United Nations that if it can prove he can solve world hunger, he will sell some of his Tesla stock. The head of the UN's World Food Programme had called on Musk and Amazon co-founder Jeff Bezos to come up with $6 billion. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
The energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely, but I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
One of the other reasons why it's so important to get those child care provisions through is that's also going to help with inflation. We got a lot of people who are unable to return to the labor market because they can't get child care. That is a drag on our economy, and it's one of the things that's creating upward pressure on prices.
It's the continued push down in Washington, D.C. in this country right now. The Transportation Secretary, Pete Buttigieg, there from New York City this morning. Good morning. Alongside Lisa Bravitz, I'm Jonathan Ferro. Together with Caddy Lyons, Tom Keene is back with us tomorrow morning. Your equity market is up 20, let's call it up 21, advancing 4 or 0.5%, all-time highs in this equity market to start a brand new trading week. 4 weeks of gains. Into the Treasury market, up 3 basis points on 10s to 158.38. The repricing here, all about the front end of the curve. Lisa, whether it's the UK, Australia, or the United States of America, we're heading in one direction, higher.
It's been a massive repricing of rate hikes to sooner. This idea of a hawkish dawn, as we talked about last week from John Author's column. But I do wonder how much freedom central banks to actually act on this, given the fact that risk markets are not faltering. I still don't know what to make of that, John.
How much of a big deal do you think we should make of Goldman coming out and saying first hike July of next year, considering that's where the market is?
It's capitulation to what people are thinking more broadly. What does the Fed do with this? And I keep going back to the idea of the employment cost index rising to the degree that it did. That gives a lot of power to the Fed to say, all right, maybe we ought to tighten a little bit sooner.
Going to be a very interesting meeting that takes place this week with a news conference with Chairman Powell as well. We'll take that special coverage, as always, right here on Bloomberg TV and radio. A report out from the Washington Post in the last hour or so. Let me read you the lead paragraph. Treasury Secretary Janet Yellen on Sunday said Democrats should be willing to approve a fix to the nation's debt ceiling without GOP support if necessary. Joining us now is Emily Wilkins down in D.C., our Bloomberg government reporter. Emily, your take on that report in the last hour?
So Secretary Janet Yellen seems to be willing to say what I think a lot of Democrats are thinking but don't want to go public with yet, that if Republicans don't come along with Democrats, they are going to have to do this via reconciliation because they're going to need to raise that debt ceiling. It's going to be much, much worse for them if they do not. Senate Minority Leader Mitch McConnell, the Republican from Kentucky, he said repeatedly that Republicans are not going to be joining with Democrats on raising the debt limit long term, that it's something that Democrats are going to need to do on their own. Secretary Yellen seems to, put 2 and 2 together and say, hey, that means we're going to have to do this through reconciliation. Another reminder, it's not that Democrats can just snap their fingers and get reconciliation done. This is a process that takes multiple weeks. Right now, they're potentially looking at a December 3rd deadline, although they could use extraordinary measures to extend that into 2022. But if Democrats want to address it before the new year, they might need to start that process in just a few weeks.
Emily, I love this quote from Janet Yellen. I don't want to play chicken and end up not raising the debt ceiling. That seems to be the game here. There has been a shift in Washington recently. Perhaps it's a reality check that we have seen, but perhaps there also is a little bit more cohesion among Democrats as they do work to get some kind of vote this week. Is that real?
I mean, you are seeing Democrats come together. I mean, at the end of the day, Democrats are very much aware that their party stands to benefit from this package being passed, and that without it, they're looking at a potential bloodbath for those 2022 midterms. And so you are seeing progress being made. You have seen them come more together. Of course, they're not quite there yet. They were initially teeing up for a potential vote in the House on Tuesday on both that bipartisan infrastructure plan and the social welfare and tax plan. That vote, not so much likely to happen anymore, but still could happen before the end of the week. Remember, next week, both the House and Senate are scheduled to be back in their districts, not in Washington. So that does set up a little bit of a deadline. Another important element here to remember on timing, if the House does vote this week on both of those bills, the infrastructure bill is going to President Biden's desk for his signature, but the social spending and welfare bill then heads to the Senate, where it needs Senate approval. And it could very easily go to the Senate, get some tweaks, go back to the House. This process could take till the end of the month, perhaps even longer.
Emily, is this enough for the Virginia gubernatorial race that really is tomorrow, as President Biden has been stumping for the Democratic incumbent and yet has been losing popularity?
This is not what Democratic nominee Terry McAuliffe wanted at all. He wanted a bill to pass. He wanted the infrastructure bill to pass. He is in a very, very tight race in a state that President Biden won by 10 percentage points. And that's not really where Democrats want to be right now. Analysts are saying even if he does wind up pulling off a win on Tuesday, this is going to be something where they're going to have to go back and really analyze what went wrong here. And so it's Terry McAuliffe, it was sort of this last minute hope for a win, hope that there could be something more that he could claim for the Democrats, but it's not happening, and that's going to set him up for a really competitive race on Tuesday.
And how will the Virginia race tomorrow set the tone for the midterms in 2022?
So Virginia, despite the fact that it did go for President Biden with a pretty considerable margin, is really seen as a swing state, particularly a swing state with a lot of suburban voters that we saw go for Democrats in 2018. And now both parties, Democrats are trying to keep, Republicans are trying to win back. So this gubernatorial race is really expected to be a bellwether for that. Another thing to keep in mind is exactly how much influence former President Donald Trump is playing here. You've seen the Democratic nominee, McAuliffe, really invoke Trump a lot, really try to tie his opponent, Glenn Youngkin, to Trump. Glenn Youngkin, the Republican nominee, has tried to sort of do this balancing act where he hasn't really fully embraced Trump, but he hasn't tried to create too much distance between him. And so it's going to, if that works out for him, if he winds up winning on Tuesday, that will provide a roadmap for other Republicans in these swing districts to go forward for the midterms.
Emily, isn't this really strange that the race is basically coming down to one candidate trying to make this a referendum on the current president and the other trying to make it a referendum on the former president?
To a certain extent, I mean, let's be clear, there are other issues at play here, particularly education, what role parents should play in education. That's been a really big component of this race for the last month, are those particular issues. But, you know, Jonathan, you're absolutely right. I mean, both Democrats and Republicans see this race as sort of an early testing ground for what's going to happen with the 2022 midterms. That's why you are seeing a little more of a focus on the national message here, even though obviously this is only to be governor of one state.
Emily, thank you. As always, Emily Wilkins, our government reporter down in Washington, D.C. Lisa, this has to be quite literally the #1 political event in this country this week.
And you framed it well, which is basically a referendum on one president or another. And it really highlights the tribal politics. And I do wonder how much is because there's too much nuance in the market now. There are too many problems that are hard to sort of tribalize, and we have to actually think about each problem. And so you just go back to what is the lightning rod. And that's what you're doing. That's, I think, what it ultimately comes down to.
Just got to jump in, Lisa, forgive me. Just some breaking news. I mentioned in the last couple of hours that Spurs, a North London football team in the UK, had lost their manager. They fired him. This is Tom Keane's team, and Tom Keane isn't with us this morning. Rumoured to maybe be in the running for that job. I stress rumoured, I stress maybe. First statement from Tom Keane this morning. He says, crushed, just crushed. Is he upset? Does he want the job? I'm trying to get some confirmation, Lisa.
You mean you think that he's politically trying to angle himself because it looks good?
I'm trying to make him a candidate.
You're trying to
take over.
Push a narrative.
I just want some free tickets, just a break for a little bit. He could take a 6-month, 12-month sabbatical to the end of the season.
He'll take a road trip.
I'm sure he
He's
will.
He's been looking for that.
He likes touring
I know.
Europe. This could work.
I know.
They're not in Europe much, though.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
Every time I go to call this a Teflon stock market, I get worried that maybe that's the day we get a correction. It feels that way at the moment, though, doesn't it? You just throw everything at it and we keep grinding out a record high. But the S&P right now, futures positive again, up 0.4%, a lift here by 20. A similar lift on the NASDAQ 100, a lift there by 0.4%. On the Russell, the small caps advancing 0.6%. Everything you throw on it, it's just not sticking. It's amazing. Switch up the board and get to the bond market. Amazing to think how much we've priced in at the front end of the yield curve, and still this equity market will not grind lower, Lisa. I'm talking to you. Yields up.
You heard me, John?
On twos by a basis point. On round two is just through 50 basis points. Lisa, but we can talk about this right now. We've got real rate repricing at the front end of the Treasury curve. At the front end in Australia, the RBA has not stepped in. At the front end of the UK, we've basically doubled at the front end of the UK and the United States in a little more than a month.
Okay, so some people come out and they say, well, look, earnings have just been so good. They've absolutely crushed it. What do you expect? And then other people say, well, liquidity is still going. I mean, pick your narrative and you can get some sort of legitimate data point to back it up.
If I said that Amazon would deliver, though, the numbers they delivered, and Apple too, and the NASDAQ would finish positive on the day, that's what we got, Lisa.
Well, you know, it's been Teflon. So I'm going to go back to the
You're going to call it a Teflon market?
No, I'm
that?
not. No.
Okay.
You heard me, John. I was echoing you.
Just wanted to confirm. I didn't say it either. Switch up the board and get to the commodity market. Let's finish on crude. WTI looks a little something like this. The president wants this lower. He wants OPEC Plus to step in and do more. At the same time, he would like some climate change issues addressed too. We can talk about the contradiction there as well. 83.72 on WTI. Will OPEC respond? That's going to be a key theme for us this week on top of everything else. Crude up by about 0.2%. That's the cross-asset price action. Let's get you some movers this morning, some individual stock names. We can do that with Romain. Morning, Romain.
Hey, good morning, John. Yeah, look, it's all about the future. In fact, you talk about the stocks that are moving higher today. It's a lot of those bets on the future. Tesla, which of course closed out the quarter, at the month at a record high. You're talking about a stock that had been range-bound for much of Q2 and Q3 here. Rallied about 43%, of course, last month, starting off the new month here, up about 4% here in the pre-market. Also in the EV space, Lucid Motors up about 8% here in the pre-market. It finally delivered its first vehicle on Saturday to customers. Of course, the stock had rallied 53% last week in anticipation of that. You're talking about a stock right now that if this percentage holds here into the close, it's going to have a market value potentially that rivals Ford Motor Company, more than $60 billion market cap on just a few $1 million in sales. And Harley-Davidson getting a boost. In fact, all the companies here that were exposed to those steel and aluminum tariffs, and more importantly, the retaliatory tariffs that the EU had imposed on motorcycles, jeans, liquor, and all these other things, all rallying here today on word the Bloomberg reporting that a truce has been set. That's not necessarily written down on paper yet, but it's anticipated that should be done by December. Harley-Davidson shares up about 8% here in the pre-market. Flip up the board, keep an eye on the vaccine stocks this morning. Novavax, which of course has been sort of the also ran in the vaccine space here, finally seems to be getting those rolling submissions going. They had WHO submission last month. Of course, they had the EU submission last week. And of course, we're getting word this morning that they finally submitted the Canadian papers as well. A U.S. approval, they're going to seek that by the end of this year. The stock up about 13% in the pre-market. Meanwhile, Moderna going in the opposite direction, down about 3% here after the FDA said it needed a little bit more time to analyze that COVID vaccine for teenagers, 12 to 17-year-olds to be specific. And keep an eye on Global Foundries, up about 14% this morning. Of course, this is the Mubadala-backed semiconductor company that went public last week. It was a pretty lackluster debut here. It actually fell on Thursday. It rallied a little bit on Friday, and now really making up some ground, up 14% here. Remember, this is the third biggest IPO of the year here in the U.S.
Romain, thank you, sir. Yep. Thank you, as always. Looking forward to the close a little bit later this afternoon on Bloomberg TV. Katie Lyons, your thoughts on Lucid? Great from Romain there. We can have a market cap the equivalent of Ford on a few $1 million in sales.
Yeah, apparently so. But I mean, goes to show you that this equity market isn't always attached to the fundamentals, which has been the story really for quite some time. And you could have, in theory, also made that argument about Tesla, although the numbers that they've been putting up lately have been pretty good. Do they, though, support the equity where it is right now?
Tesla, a $1 trillion company, Lisa, trading like a penny stock, up more than 40% since the start of October. Just unbelievable.
Is it a car company?
I think we can call it a car company. They make cars, don't they?
Well, I mean, is that the main business?
Should we value the stock as a tech company, I think is what you're getting
Well,
at.
I mean, yes, although you talk about companies being what they are because it is their main purpose. And I do wonder if we're going to think of Tesla as a battery company in the future.
Interesting.
Or a space company.
Interesting.
Is it?
Yes.
Or is it snark?
No. I didn't spend enough time thinking about that. So I appreciate it. Why do you all think everything I say now is just snarky? I listen, and this is like authentic reaction. That's what's beautiful about this show. I'm just, fascinated listening to
always listening.
Always listening.
Ramble on.
Joining us now is Porrick Garvey. I want TK back. Where's Tom? How long did that take you? 90 minutes. Porrick Garvey joining us now, Global Debt and Rate Strategy Head at ING Financial Markets. Porrick, great to catch up with you, sir. We've been going through these central bank decisions through the week, all this morning, the RBA, the Bank of England, the Federal Reserve. What do you make of the move, the repricing of rate expectations we've seen, Porrick?
Yeah, it's overdue, I would say. I mean, the front end of the UK curve is a step ahead of the rest. I think there's been a big fuss made out of the front end of the US curve. I mean, I see 50 basis points for the 2-year as nothing more than a really benign reflection of where we're likely to go over the next couple of years. I mean, we got to remember, if you buy a 2-year bond today, it matures in November 2023. In all probability, there's going to be quite a few rate hikes between now and November 23. So when I look at that 2-year at 50 basis points, I think it's pretty neutral. And in fact, we're a bit more aggressive than the marketplace in terms of rate hike expectations. And realistically, the path there should be for that 2-year to get up to close to 100 basis points. You've got to remember, the last time the Fed pulled the trigger, the 2-year was up at 90 basis points. Now, the Fed is not going to pull the trigger anytime soon. We've got some other stuff to get on with before that. But it's quite a move. I think the one that looks a little bit off is the front end of the Eurozone curve. We're not convinced that's as true as it sounds in terms of rate hike expectations.
Porrick, some people argue that the reason why markets are not really responding to the repricing of rate hike expectations is because it's not when the Fed lifts off, it's how many hikes there are. And that if there's a sooner hike, that means it will be a shorter cycle and that we will see growth decelerate significantly thereafter. Do you buy into that narrative, that basically we're just bringing them forward, we're not increasing the number of hikes or making it a tighter cycle?
I think the issue here, Lisa, is the room that's provided to the Fed by the 10-year part of the curve. You know, we look at the 10-year today, it's 160. It's had a tendency over the past week to fall. It's really important that that 10-year rises towards 2% so that the Fed has got room to hike. You know, if that drifts down to 150, 140, 130, there's an issue. And I think that's the point. And that is why the 2-year is having difficulty, because the 10-year shouldn't be a 160. If you look at the fundamentals, it should have a handle of 2. And there is a real dilemma in terms of where the 2-year should be going to in the back of that.
Well, let's talk about the 10-year then. Where would that 40 basis points of upside come from? What catalyst?
So I think one of the interesting things is this week, in the sense that we should get a taper announcement from the Fed. And I think the big thing there is not the fact that the Fed will be buying less. We know that's what taper means. The really important thing is that the Fed will morph from adding reserves to taking reserves out of the system. They'll take about $1 trillion out of the system at least. And that's where the pressure will count. And it will force rates up, and it will put pressure on risk assets. And not an awful lot is spoken about that.
Do you think the chairman's got some form of consensus on that Fed right now, Porrick? Do you think it exists? We heard from Jim Bianco of Bianco Research, and he said something to me a couple of months ago that's just stuck with me. This chairman is probably finding things quite difficult in these news conferences because it's very hard to put together a consensus on that committee and reflect it in the news conference. Does that resonate with you?
It does to an extent, but I think it's very clear if you listen to Chair Powell, he has slowly morphed from being ultra dovish to a serious tint of hawkishness. I mean, he's called for tapering at this November meeting, practically after the last meeting. And it does appear to us that he does have the committee. And, you know, going with the tapering is relatively straightforward because the technicals on the front end absolutely demand it. We had 1.5 trillion going back to the Fed last Friday, which is a measure of an excess of liquidity. So that needs to be addressed. And that's why the taper makes an awful lot of sense anyway, purely from a technical perspective. So this is a relatively easy one to pull off, I would suggest.
Porrick Garvey, great to catch up with you, as always, of ING Financial Markets. Lisa, a tricky moment for this chairman of this Federal Reserve.
I don't see why they wouldn't taper at this point. Why wouldn't they taper in November?
Oh, it seems like that's done, right?
That's done,
That's
right?
done.
So the issue is, how much are they going to push back against rate hikes? And why would they even do that? Because it's not disrupting markets. So I don't understand why they would push back against that, especially with the employment cost index coming out where it did on Friday.
If you don't push back, we add more. It seems to be the game, the marketplace. I mean, that's the issue, isn't it? And I know it sounds really, really childish, but if you don't push back sufficiently, you have to be so careful about what you say, because as a market participant, you start to think, oh, limited pushback here. Maybe they are leaning that way. Let's add some more. And you keep testing, you keep pushing it. It literally is sometimes, and when I say this, forgive me to all the rates people out there, the market does behave a little bit like a toddler pushing its boundaries, Lisa, waiting for someone to say enough, and you keep pushing, and it just seems to be the game we play all the time.
It definitely seems to be the way that it reacted in 2013. Some people have come out with notes, though, saying that the toddler is now a teenager and is dealing with the guidance a little bit more. I mean, we can get into the whole parenting analogies that we've seen kind of bleeding into rate strategy.
These are highly educated toddlers. Let me just throw that out there before I start getting some emails from some good friends for calling them children. Your equity market up 0.4% on the S&P, advancing about 20 points. There's a nice lift in this equity market again. All-time highs, and we keep repeating ourselves, even though there are reasons seemingly for a lot of people that this market should perhaps go a little bit lower. Your bond market yields up 3 basis points on 10s to 158.73. From New York City this morning, good morning. On radio, on TV, it's a beautiful one. This is Bloomberg.
With the First Word News, I'm Laura Wright. Jess Staley is out as CEO of Barclays. He's stepping down in the midst of a British regulatory probe into how he characterized his ties to the late financier and sex offender Jeffrey Epstein. The bank says it was made aware of the preliminary findings on Friday night and says Staley plans to contest the findings. He'll be replaced by the head of Barclays Markets Division, C.S. Venkatakrishnan. More than 5 million people around the world have died from the coronavirus, less than 2 years after it was first documented. Still, the arrival of vaccines has slashed fatality rates. The latest 1 million deaths came slower than the previous 2. The death rate has returned to what was seen during the first year of the pandemic, when the virus was still taking hold. France and the UK are headed for a full confrontation in the next 2 days over fishing rights. On Tuesday, the French government is set to introduce additional controls on goods moving across its border with the UK. Plus, British fishing boats will be blocked from unloading their catch in France. That's as in response to what Paris sees as unjustified restrictions on French fishing boats. In China, the economy slowed further, showing signs of weakness in October. Power shortages and rising commodity prices weighed on manufacturing. The official Manufacturing Purchasing Managers Index again fell below the mark that signals a contraction in production. Meanwhile, strict coronavirus controls put the brakes on holiday spending. Moderna says US regulators need more time to assess whether its coronavirus vaccine can be used for children aged 12 to 17. According to the drug maker, the FDA is reviewing international analysis on the post-vaccination risks of a heart condition. The review may not be complete before January. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you look at technology, how should we be looking at big banks and technology?
Technology is our friend. So it's helping us transform the bank fundamentally. And in fact, we're speaking, I think, as we speak, to our shareholders around what we've done and how we've transformed the bank. We also see technology, and technology companies as partners. So some
Not
of our
rivals.
You know, we know that there are big parts of what have been our business historically that will be absorbed into convenience platforms. And by convenience platforms, whether that's Amazon or Facebook or Alibaba or Tencent or something like that, those are platforms that are just very convenient for people to conduct their day-to-day financial affairs. And it'd be very difficult for a bank to compete with that. Now, in some cases, I'd say, let's say in Africa, we are setting up a competing platform to the convenience platforms. And we're working with technology companies and mobile telephony companies and others to create a platform of our own. But for the most part, we're going to be playing on somebody else's platform.
Monday on Bloomberg Television and Radio.
We are on the verge of a disaster.
Join us live from Glasgow for coverage of the COP26 Climate Change Conference.
People are beginning to build some momentum, I think. The question is, will it be enough?
We'll speak with global leaders, keep you up to date on progress and setbacks, and analyze what it all means to you.
We're going to need to see some real action.
COP26, the UN Climate Change Conference. Special coverage on Bloomberg Television and Radio.
You talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, you know, what the challenges with getting people back into the workforce.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about